Good afternoon, ladies and gentlemen, and thank you so much, very much for that kind introduction. It's a wonderful pleasure to be here in front of all of you, and I hope I can add some perspective on kind of the larger global picture and our broader regional equity views to the very detailed analysis that you've already had on India, both from the fixed income as well as the equity side. So without further ado, let's go straight into our presentation here and our thoughts. I thought it'd be a good idea to give our key points up front so you can know exactly where we're going in terms of this presentation. And there are a number of quite straightforward points that we have in terms of our view for the global asset backdrop and more specifically the outlook for Asian equities. And the one-line summary is that we remain positive on Asian equities, in particular on China and India, as I'll elaborate in a moment. So there are three key reasons why we think the environment right now is still conducive for further equity gains. The first one, which was just discussed by the previous presentation, is that monetary policy has eased very, very substantially in the past 3 months. There's been a big change, or a so-called delta, between the setup at the end of 2018 and the current situation, and I'll show you lots of examples of that in a moment. So point number one is that financial conditions and monetary policy have eased quite significantly. Point number two, which is somewhat more contentious, but there's increasing evidence of this in the recent data, is that growth is picking up globally. You may recall that about 3 weeks or so ago, there was a lot of concern in the market about a so-called inverted yield curve in the United States. And to be clear about this, that means when the short-term interest rates are lower than the long-term interest rates, which typically is a sign of an impending recession. So lots of debate in the market about growth slowing down. In fact, our view has been that growth is likely to be accelerating and picking up in the global economy, at least in the second quarter, and the recent data coming out of both the United States and China is certainly supporting that contention, and I'll show you some evidence of that in a moment as well. The third point, of course, is at the micro level, we think that the persistent trend of downward adjustments in earnings that has been the case for at least the past year is beginning to inflect, it's beginning to improve, and so at the micro level we're seeing the improvement in the global economy filter down to a stabilization of earnings growth, and of course that's very good for equity markets. So that's the good news and the three key points why we remain constructive on markets. However, we have to recognize that the markets have had a very, very strong performance year to date. In fact, the US stock market, as I'm sure many of you are aware, hit a new all-time high just yesterday's close, completely reversing the very scary nearly 20% down drop that we saw late last year. So with that significant rise in markets, it means that the so-called oversold recovery in valuations that we've seen this year, that part of the trade is basically done. And therefore, from here, we actually need earnings growth to power markets. That's very much the message that Mahesh was making on India just 2 presentations ago, and that's very much our view as well. Fortunately, we think that earnings growth will be reasonably good from here, so that will give us still some trended upside in equity markets, and more specifically within the Asia-Pacific region, we favor the equity markets of China and India for reasons I will elaborate a little bit more further in detail. Finally, thematically, we think that a good place to be within the equity markets, it would be the 2 themes of either growth or yield. Growth, of course, because everyone wants stocks that are growing well, as long as you're not overpaying for them, and yield, of course, against the backdrop, at least outside of India, of a quite low fixed income environment. So the attraction of, say, a 4 or 5% dividend yield, which you can get on many stocks in the Asia-Pacific region, is of course enhanced when you are seeing your alternative of interest rates being lower for longer. So that's basically our message. So let's dive into some charts on this. So the first chart here, what we can see is our chart of what we call global financial conditions. So this is a broad measure of interest rates. Technically, it's got a little bit more in there. It's short rates, it's long rates, it's trade-weighted exchange rates, and so forth. But you can think of this as generally the overall situation for global financial conditions. And the way we've plotted this chart is that up means that financial conditions are tightening, which generally is more challenging for assets. Down means that financial conditions are easing. Well, as you can see from this chart, if you look carefully, there was a very strong tightening of financial conditions late last year, which was, in our view, one of the prime reasons why asset markets were under such pressure. Fortunately, this year that's been unwound to a very significant degree, and we think this is the prime reason for why we've seen a lift in equity markets across the globe, including here in India. Now, drilling into this a little bit in more detail, the Fed is really the one who's led the charge on this. And what you can see from this chart is the federal funds rate, and if you concentrate on the right side, you can see what the expectations were, both for the market and for us at Goldman Sachs, at the end of last year compared to now. And the key message is that at the end of last year, the market was expecting the Fed to tighten 1 to 2 more times. And in fact, we were more hawkish, thinking the Fed might raise even 4 times. Now, we're actually seeing the market price in no hikes, and in fact, a 50% chance of a 25 basis point cut. And our Goldman Sachs economists now expect no Fed hikes this year, and in fact, just recently extended the expectation for the first hike from the first quarter of 2020 to the fourth quarter of 2020. So clearly this is a much more benign situation for the US economy, and also since the Fed is the key determinant of global monetary policy, it sets a very strong signal for monetary conditions globally. And of course, this is exactly what we've seen, for example, in Europe. This is a chart of the European Central Bank, the so-called ECB, a similar type of chart where we showed what the expectations were at the end of last year and where they are now. And the message is the same. The expectations have come right the way down, obviously, of course, keying off of the speeches by Central Bank Governor Mario Draghi and others. So if we turn back to the United States, we can see that financial conditions have done a complete reversal. If you look at the right side of this chart, we saw the very significant steepening in this line, which means that financial conditions were tightening very significantly right up until the point the Fed made its last interest rate increase in the middle of December, which is when markets were really in a turmoil and the equity market sold off very, very abruptly. Since then, the Fed has had a complete reversal, a so-called dovish pivot, and that has meant that financial conditions have eased significantly. And if you look carefully at the chart, you can see that about 3/4 of the tightening that we had in the second half of last year has now been completely undone. Again, a very constructive backdrop for equities. And the reason why we think this persists is on this chart. This shows the outlook for inflation in the United States, which we think will remain well below the 2% Fed target rate until we get into the middle part of 2020. And since the Fed is contemplating perhaps even allowing inflation to go somewhat above its 2% targeted mandate, we think that means they will not be inclined to tighten policy until the back end of next year. So the message here really is one of lower for longer interest rates. And of course, what that's done is it's resulted in a ripple effect through the world, particularly into our region, the Asia-Pacific region. And what this slide shows is the difference in our own in-house forecasts for the 11 economies that we cover in the region last year, at the end of last year compared to now. And we won't go through all the detail on the slide, but the key punchline here is that we have softened our expectations for monetary policy in 8 of the 11 economies that we follow. So clearly this dovish tilt has propagated throughout the various markets that we're looking at, and obviously that's supportive for equities. So the reason why that's important, just to make that connection, is that there's a clear historical linkage between the valuation of Asian equities and the general backdrop for financial conditions. What we've done in this slide is to plot our Asia-specific financial conditions index. In this case, we've reversed it so up is easy and down is tight, and we superimposed that on a chart of the Asian equity index forward price earnings ratio. And you can see that, broadly speaking, these two kind of move in line. So the recent easing in financial conditions, which, as I said on this chart, is up, means that it's supportive for valuations, which is exactly what has happened. So easy money has led to better backdrop for Asian equities, and this is clearly something which is supportive for the overall view. Now, in addition to that, there's a clear additional positive, which is that financial conditions, not financial conditions, but quantitative tightening is off the table. So if you look at this chart here, what we're doing here quite simply is adding up the G3 central banks, and we do so in a weighted average basis. So the key point to focus on in this chart would be the red diamonds. And in contrast to last year, when balance sheets were basically compressing, particularly because the Fed was rolling off its balance sheet. This meant that the decade-long easing of money, the so-called quantitative easing, which had very clearly supported assets, was going into reverse. And of course, we all know what a difficult year last year was for asset markets, particularly for equities, whether it was the United States or Europe or Asia ex-Japan, which had its fourth worst year in history. The good news is that the Fed has basically said they're going to stop the roll-off of the balance sheet at a higher level and at a sooner time, end of September, basically saying that quantitative tightening is over. So the bullish combination here is that we're easing interest rates, signaling they will be lower for longer, and taking quantitative tightening off the table, and that, of course, is a very powerful supporting element for equity markets broadly. So that's basically big driver number one. Big driver number two, of course, is growth, as I mentioned, and this was, I think it's now becoming more consensus, but even as recently as sort of 3 weeks ago, this was much, much more contentious, as I mentioned in my opening comments. What this chart here shows is our global current activity indicator. That's the CAI on this blue line. That's just simply our in-house measure of monthly GDP growth. It's a spot estimate of how the global economy is growing. And if you look carefully at the right side of the chart where we've highlighted that in the red oval, you can see that growth is beginning to pick up empirically. In fact, the recent data point was 3.6% for the early read for April, and that's up from below 3% at the end of last year. So clearly there's a sign that the global economy is beginning to pick up some momentum. There's some debate about how far it can go, how long it may last, but our message is enjoy it while it lasts, and we can sort of worry about maybe global growth perhaps beginning to plateau later in the year or in 2020. But for now, we think, to maybe be a little bit colloquial, the party is on. Now, to be a little bit more specific about this, we can see in the near term how we think the second quarter may evolve compared to the first quarter. The big pickup, of course, is in the United States, coming off a seasonally weak first quarter. We also see some strength in China, and which I'll elaborate on more in a moment. And in aggregate, we're looking for the global economy to continue to firm, as I mentioned. So again, we've got this nice interplay between growth and between rates. Looking at the financial conditions impact on growth, because these things are linked, what we can see in this chart is, if you look at the blue line, that was the impact that tight financial conditions were going to have on growth in the United States at the end of last year. So we're looking at a very subdued outlook for growth because of tight financial conditions. And as you can see from the red line, it now looks much, much more benign. So there's this interplay between the easing by the Fed, which is the primary driver of the good news for equity markets, and how that is manifesting in terms of growth. Now, turning to China, which of course is the world's number 2 economy, and remember that the US and China together are about 45% of the world's overall GDP, what we see here is that after a significant slowdown last year, which was manifesting in a very weak equity market and a lot of concerns about that negative effect that China's economy was having as spillover into the global economy, that is clearly having signs of turnaround. And the most recent data points, we've just seen China print a first quarter GDP number of 7.1% in sequential annualized terms, whereas only 4 months ago, we thought it might be less than 6%, something like 5.8. So the government stimulus measures have clearly had a very significant impact. And what we can see here in this chart is our overall in-house index of China's policy. This is an aggregate composite of monetary policy, fiscal policy, macroprudential regulatory policy, as well as the impact of the currency. And again, what we see is that last year this chart was going up, the line was going up, which is an indication that policy was tightening. This year, or in the last few months, we've seen this chart hook over and begin to show signs of ease. And as the dotted line suggests, we think this will continue further. So again, in China, the outlook is that very clear evidence that they've been easing policy, and we expect policy to remain accommodative, certainly for some time to come. So this brings us to the combination of growth and rates, and this is one of our favorite charts, so it's one which I just want to spend a few more moments looking into. We call this our growth rate jaws, the metaphorical jaws, and let me just explain. The dark blue line is our global current activity indicator, which is basically our global growth measure. And the lighter blue line is our global financial conditions index. So you can think of this as the interplay between growth and rates globally. Now, if you look at the middle part here where it's in black, the first part, the black rectangle, this was 2017, where growth globally was accelerating and rates were very, very easy. So the metaphorical jaws, the gap between growth and rates, were widening. And that was a very, very positive backdrop for global equities. And of course, we'll remember that was a year when, for example, the MSCI Asia Pacific ex-Japan Index went up 34% for the fifth best year in its entire 32-year history. Then we go to 2018, which is the red rectangle, and we saw the exact opposite. Global growth slowed significantly and more than people were expecting at the beginning of the year. And rates, of course, kept rising because the Fed was persistently raising rates and other economies were beginning to follow suit. So the jaws were snapping shut. Bad year for equities. And as I mentioned, the MSCI Asia Pacific ex-Japan Index fell 16%, the fourth worst year in history. So now we come to this year when the jaws are beginning to open again, not as much as in 2017, but still opening up because we see this easing in financial conditions and a pickup in global growth. And this opening up of the jaws, the re-widening of them, is of course very good news and is very supportive for equities. So I think this is a very simple metaphor, a very simple construct, which really helps to explain and capture a great deal of the global macro dynamics and also underpin why we should remain constructive on equities. To hammer this point home, we have the following chart, in which the blue line is the spread between the growth and the rate. So this is the jaws. So when the line is going up, it means the jaws are opening. When the dark blue line is going down, the jaws are closing. And the lighter blue line is the rolling 12-month price return for the broader regional MSCI Asia Pacific ex-Japan Index. And you can see just visually, there's quite a good correlation. So this shows that there's a connection between this growth rate interplay and how well the equity markets in the region are performing. And of course, if you look at the right side of this, after undershooting last year, partly because of trade issues, which I'll talk about a little bit later, we're seeing a snapback and we expect further improvement as the year progresses. Now, so those are the big global rate and growth dynamics. And then the third point, remember, that I was making is that that's beginning to manifest at the micro stock market specific level of earnings. And what we're showing here is a proprietary indicator we developed about 2 years ago, with which we've had great success. And in simple terms, what we're doing is translating a very large amount of high frequency macro and sector data into forecasts for how the sell-side consensus analysts will revise their earnings. And you can see from this chart on the right side that we've had pretty good success in terms of predicting both the direction as well as the magnitude of revisions over the next 1 to 2 months. And the punchline here, if you look at the right side of the chart, is that after this persistent set of downgrades to very, very bearish levels, we're seeing an inflection upward, i.e. to the positive. And so we are making a call, and we have been doing this for the past month, that the earnings downward revision cycle is ending. And that, of course, is very good fundamental news for equity markets. To give you a sense for why this is important, we have this chart here. The blue line is the broad regional equity index, and the black bars are the breadth of the analyst revisions. In other words, the number of analysts revising up minus the number revising down. And what we can see from this chart, if you look carefully at it, is that the market tends to look ahead, and it doesn't wait until the analysts overall start revising up or start revising down. It actually looks at the inflection points, what we call the so-called second derivative, where the market tends to turn up when the estimates get less bad. In other words, when the cycle is beginning to turn. And that's exactly what we've seen this year. So again, if we're making a call that the earnings revision cycle is beginning to stabilize, that's something that the market tends to like. So this is our expectation of earnings growth after a long period of successive downgrades to earnings growth and a slowing. We expect on a quarterly basis for earnings growth to pick up into the end of this year, which obviously is good news and something the market has anticipated. And to show you one of our all-time favorite charts, this is the long-term sort of 30-year plus perspective of the MSCI Asia Pacific ex-Japan Index, which is the lighter sort of gray line, versus the underlying earnings per share of the index, so the level of earnings for the broader regional index, which is the dark blue line. And the key fundamental point, which I would really encourage everyone in this room to take on board and really implant in your minds, is that in the longer run, markets follow the direction of earnings. Sure, they get more excited, at some times, or more depressed on some times. That's Mr. Market getting more enthusiastic or more depressed. But fundamentally, if you can get the broad direction and magnitude of earnings growth, you can broadly get a sense of where the market will be heading. And so the key point here is that after this downturn that we see in the upper right side of the chart, we're seeing earnings begin to stabilize and begin to pick up again. And that, of course, is very good fundamental news for the broader equity market. So those are the 3 points: better liquidity globally, better growth globally, translating into earnings growth. Overall, that's basically our investment thesis for a constructive market view. But then we have to ask ourselves the question, we have to recognize that markets are discounting mechanisms. They look ahead, and so how much of all this good news is priced in? And unfortunately, maybe the less good news, the bad news, is that the very strong returns we've had year to date, in our view, price a lot of this good news in. So we've gone from a period of being oversold, and to give you the numbers, at the beginning of this year, the forward price earnings ratio for the MSCI Asia Pacific ex-Japan Index was 11.5 times. It was oversold relative to most of our fundamental metrics. Since then, we've rebounded 18% in valuation terms to about 13.6, which is that's the updated figure, a little bit above where we show in this chart. And that, as you can see from this chart, is pretty much in line or even slightly above what our top-down macro PE model suggests. And as you can see from this chart, our top-down model does a pretty good job of capturing and describing what the appropriate level of the index should be based on background macro circumstances like growth and rates and the level of the S&P valuation as a benchmark for global equities and a few other fund flow measures. So the point of this chart is that we've priced in or recovered a lot of the oversold aspect of things, and therefore from here, markets need to have underlying earnings growth in order for them to continue their upward progress. There is a supporting element, however, which is that we think that underlying positioning by investors is still fairly conservative. In other words, investors got quite scared at the end of last year. We had a very bad fourth quarter, as I'm sure everyone in this room is aware of, and that caused many investors globally to be quite conservative, to pull in their metaphorical horns. And so what we see from this chart is that the positioning of nearly $2 trillion worth of global mutual funds in the Asia-Pacific region is about 600 basis points below their benchmark level and below, even 200 basis points below the 10-year average of about 400 basis points underweight. So we think there's actually quite a good positioning argument which can be still supportive for markets and might indeed lead to a bit of an overshoot in the near term. So that's sort of our overall construct. So where does this leave us globally? This is a fairly complicated slide. We're happy to send it to people later on. But it's basically our global asset allocation mix. The punchline, particularly for those of you who may not be able to see it as clearly in the back of the room, is that we're overweight equities. We continue to like them, although we think overall returns from here will probably be more single-digit positive as opposed to sort of 15, 20%. We think that having some cash on hand is a good idea as a hedge against some volatility. And we're underweight, in particular, government bonds because we think that they are quite richly valued right now. Without getting too technical, there's actually a negative term premium in, for example, 10-year U.S. Treasury bonds, which we think suggests that they're not as good value as the equities are. So that's basically our broad global asset allocation mix. Now, we've got two interesting indicators that we've introduced at Goldman Sachs. We're busy trying to always add some value to our investors. So one of them is something we introduced nearly 2 years ago, which is a global bull-bear indicator. It really is centered on the U.S. You can think of this as kind of an S&P bull-bear indicator. It's longer-term based, so it's not going to catch every single inflection point in the equity market. But the key point is that having signaled some caution, particularly late last year, which obviously manifested as the S&P fell nearly 20%, it's actually come off recently and is signaling some greater signs of confidence, if you would. And closer to home, this somewhat busy chart is a recent indicator we just introduced about a month ago. It's our Asia Pacific bear market indicator. And what this shows is that, again, this indicator became concerned in January of last year, so it would have basically helped us dodge that big downturn that we had last year. And recently, with the improvement in the global backdrop, the index has declined somewhat, and up on this chart means bearish and down means bullish, so we're actually coming down and it's giving us a more constructive signal, although it still has some concerns overall. So I just want to sort of throw these into the mix here to give an indication that at the margin, even these more conservative indicators are giving us a somewhat more optimistic signal. So where does this leave us for our regional views overall? We summarize them on this table. Lots of detail we don't have to go into. The punchline is that we're looking for about 6-7% price returns from the broad regional index on a 12-month view, which is in line with our estimate of the underlying earnings growth. We think that can be topped up by about a 3% dividend yield, so we still think we can get 9 to 10% total returns in US dollars from the regional index, which is still a very credible rate of return, especially against a low interest rate environment. Within the region, our two favorite markets are China and India, and I'll give you a little bit more elaboration of that in just a moment. And of course, thematically, as I mentioned earlier, we like themes such as growth and yield. Now, turning to a couple of wild cards, which I haven't yet discussed, and which are obviously very relevant for India. Number one, of course, is oil. So we have a commodities research team, which we're very proud of, who are well regarded in the market, and our expectations for oil are shown on this chart. We think basically we're at the upper end of a trading range for oil. So I know there's lots of concern in the market that with oil at the low 70s on Brent, that if it spiked up further to say 80 or so, that would be quite negative for India, given India's reliance on imported oil. Our message here is that we think that we are likely to gradually subside to about the $65 a barrel range for a variety of demand and supply and geopolitical indicators I don't have time to delve into too much here. But that's basically our view on oil for what it's worth. Number two, of course, is the dollar. And here, our view is that if you looked at the dollar alone, we would expect some moderate softening in the dollar. But the question, of course, is against what? Because foreign currencies, or any currency, is a relative price. It's not an absolute price. And so when we look at the dollar against the developed market currencies, the euro's not looking terribly great right now, and neither is the yen. So it kind of suggests maybe some stability until we get further into the year, maybe see a little bit better signs of fundamental strength in either Europe or Japan. Against the broader emerging market complex, and particularly within Asia, we're somewhat more constructive, but again, given the easing of monetary policy that we've seen in a number of countries and that I briefly described, it suggests that the investment case for Asian currency strengthening against the dollar is also somewhat more muted than we thought at the beginning of this year. So really the message here for the dollar is kind of broad range trade with maybe a little bit of softening in terms of our bias. So overall, we think it's probably not going to be as destabilizing a factor as it was last year. The third wild card, of course, is China and US trade relations. This is an index of so-called trade uncertainty, which is a word count of 2,000 publications in the US citing evidence of trade. And the key point after this very intense focus on trade last year, which of course corresponded to a significant pressure, particularly on China's equities, we've seen a moderation in this and actually an improvement in the quality or the nature of the trade news. And now people are more optimistic that some sort of a deal will be done between the US and China, perhaps in May, maybe even a little bit later. So our core view is that we think some sort of a deal will be done, and that, of course, will be favorable, although we do think the market has priced a lot of that good news in. So we have to watch this carefully, but the key message for now is we are certainly more optimistic on the trade outlook than we were, say, 6 months ago. Now, just quickly turning to China, and I know this is not the main focus of the audience here, so I won't go into too much detail, but we still think there's a very clear investment case for China, which can be summarized by the key points here, which basically are that the economy is improving, earnings are growing, sort of 10%, 12%. Valuations are still quite reasonable. Even after the very significant increase in the market, we still find either the offshore or the onshore China equities trading about 12 to 12.5 times earnings. Foreigners are underweight. Local retail investors are underweight, but just beginning to come back to the party, and they can tend to be very speculative when they really get going. So that's kind of some upside liquidity boost that the domestic market may have. And there are a number of important catalysts that you should be aware of. One of them is the inclusion of China A shares, the onshore stocks, into the global indices. Now this is important, as I'll show you on this chart here, because China A shares, if you focus on the red slice, this is their weight in the emerging market index, the global emerging market index, is going from 0.8% now to 3% at the end of this year. And if the inclusion factor continues to rise to a full 100%, then at some point, perhaps in about 5 years' time or so, the China A shares will be 15% of the global emerging market index. That is important because no other market in the index currently has a 15% weight. Even Korea, Taiwan, India are only sort of, 12%, 11%, 8%, and so on. So there will be some reapportionment and maybe a little bit of weight on other markets as people sell some other markets to reposition into China A shares. So that's one thing from an Indian investor standpoint that we want to be mindful of. So overall, there are a number of clear reasons to remain constructive on China, and so that is something which we want to emphasize. This is a chart showing at least some potential for how the China A shares could continue to increase, which underpins our constructive view. Let me close my prepared comments with just a very quick overview of our view in India. I realize that you've already had a very comprehensive discussion by my cohorts here, both on equities and fixed income. We just want to share with you our perspective, maybe from a so-called foreigner's perspective, of why we think the investment case for India remains constructive. I'm just going to show you 5 charts, 5 quick reasons. One, we think that on balance, the overall fundamentals will be improving. So we think that the cyclical slowdown in India is showing some signs of plateauing. We actually expect things to begin to improve as we go into next year, number one. Number two, inflation, as mentioned earlier by my colleague, is at the lower end of the RBI's targeted range. And of course, that means that the RBI can continue to be accommodative, and we expect another 25 basis point cut in the third quarter. So that's sort of the macro. At the micro level, we see clear signs that earnings are beginning to pick up, particularly against a very easy base of comparison for calendar 2018, fiscal 2019. Now, we are below consensus for this year and next. We're looking for 16% and 14% growth. Consensus is sort of 20% or thereabouts. But even being below consensus, India would be the #1 growing market in terms of earnings of all the 11 markets that we cover. So the compound growth this year and next, we think will be 15%, and that's considerably above any of the other markets that we cover, and therefore we think fundamentally that's a really good and constructive reason to be encouraged about Indian equities. Now, the pushback that we have to share with everyone here from our many meetings with investors globally is, yeah, we get that, but India's kind of expensive. And that is true. The market's trading at 18 times earnings, which is certainly much more expensive than the regional average of 13.5, as I just mentioned. However, we would note 2 points on these charts. On the left side, we have a macro top-down model for India, which is the exact analog of what I just showed you for the region as a whole. And that suggests against the current backdrop, 18 is probably about fair, number one. Second point on the left side chart shows India's premium valuation relative to the rest of the region. And that had gotten as high as nearly 55-60% last September, which is when we downgraded our market view. And it's since come down. It's still expensive, but it's still in a much more reasonable range relative to history at about a 30% premium. So we're not arguing India's cheap. We're arguing that it's actually okay and probably fair value relative to the macro and earnings backdrop that we see. And then, of course, there's the near-term issue of the elections. Of course, we're not taking any view on the elections, but what we do note is if you look at the last 6 election cycles, which is what we show on the left side chart, that the market tends to perform well into the elections and still about 1 month afterwards. So at least in the very near term, when we have sort of a month to go before the final count, and then afterward, we still think we've got some near-term kind of historical tailwind at our backs. And then, of course, the final point relates to positioning, both for foreigners as well as for domestics. And the key points here are that from a foreign perspective, there was very significant net selling last year of about $5 billion US dollars outflow. And that's significantly reversed, as you see in the right side chart on the upper right. And in our conversations with investors, we note that after China, India is the market we're getting the most questions on and the most interest on and the most interest in sort of discussing the pros and cons of. So I think what it says is that people generally, foreign investors generally appreciate the longer term investment appeal of India, and people are trying to parse through the cyclical issues, the election issues, and of course the valuation issues. And then of course to finish and to complement that, on a domestic side, we all are aware that the domestic investors have been a very strong bulwark for the market, a supporting factor. That kind of tapered off somewhat last year, as you can see on the lower left side chart, but is beginning to see some signs of inflection upward. And of course, we see some very stable, persistent inflows from the systematic investment plans, which are a very good and continuing supporting factor from a demand-supply standpoint for equities. So in sum, we see cyclical improvement for India at the macro. We see earnings beginning to pick up, and in absolute terms, being better than anywhere else in the region. Valuations, we think, are full, but supportable, and we don't see a major risk of a valuation contraction. The election, of course, we think historically is a good time when the market tends to be fairly buoyant, and we think from a demand-supply of equity perspective that there still are reasons to be constructive. So let me stop there, and thank you very, very much for your time and attention. Thank you so much, everyone.
Thank you for that, Mr. Mo. So we'll just take a couple of audience questions, and as we are very digital today with our Voyage 2019 app, we've got the questions on the app. So if we'll get the first one, if the first one could be put up, I'll read it out while it's coming up. With easing of the monetary policies in the major parts of the globe, markets seem to be on a recovery. If liquidity tightens in the next 18 to 24 months, where do you think imbalances lie, and what will be its impact on China, US, and India?
Okay, that's a great question, and we could probably spend an hour on it, which I know we don't have. So I'll give you a very abbreviated answer, and I apologize in advance if it sounds clipped or assertive, and I don't go into all the underlying thought process. So, I mean, the first part of it is basically kind of what if financial conditions tighten. As I hopefully explained pretty clearly, we don't think that's going to happen, but if it did, clearly it would be a negative, and I think especially so because with asset markets having reflated, they would be that much more vulnerable to a shift in the wind and to a tightening of financial conditions. So that'd be the first part of the answer to the question. The second part is where would the financial imbalances be revealed, so to speak? And I think it's fair to say that when we've had 10 years, a decade of quantitative easing and ultra-low interest rates, there has to have been some bad behavior which cropped up in some aspects of the global arena. A couple of areas that come to mind, I think, would be in the United States. There's some aspects of the high yield market where people have become over-leveraged. So we see corporate leverage ratios having gone up considerably as people have understandably taken advantage of low interest rates to gear up and to term out their rates. So there could be some stress in areas there. There's also clearly in the government level significant imbalances and budget deficits, and just to cite one aspect, underfunded pension plans, which could come under some stress. And the question also mentioned China, where there's perennial concern about excessive debt burdens. For a variety of reasons, we think that the more extreme bearishness about China debt and systemic concerns are overblown, but there's no doubt that there is, or there has been, malinvestment and inappropriate decisions made, particularly in the so-called local government investment vehicles. And so I think if there was to be a significant tightening of financial conditions in China, the so-called LGFVs and some parts of the private sector, I think, would be arguably most at risk.
Superb. Thank you for that. Let's take one more question. We'll just wait for it to come up on the screen. In the push and pull of things among slowing growth, easing liquidity, and expensive valuations in the USA, would you believe that there could be a further correction in USA before liquidity drives growth back? If yes, what is the contingent to India?
Okay, so this is a great question. Obviously, it's a relevant one to ask. As I noted, we've had one of the swiftest V-shaped recoveries in the S&P index in history. And so we're back up at the all-time highs, and so valuations have recovered and they've reflated. We don't think the U.S. is crazily overvalued. In fact, David Kostin, our U.S. strategist, still has a little bit of upside to his 3,000 year-end target, which is based upon roughly 17.5 times forward price earnings ratio. So the U.S. has been more expensive, and at current valuation levels, we think it's on the full side, but not sort of crazily overdone by any stretch of the imagination. That being said, if for whatever reason there was a break in the U.S. market, perhaps because maybe there would be a shift in expectations for the Fed, maybe the Fed decides that things are going great and therefore they just start to tighten again, which I think the market would not like, or maybe some other geopolitical shock happens, maybe something in the run-up to the 2020 election, or any other reason that you could hypothesize. But let's just say, for an argument's sake, that the U.S. market has another scary correction like we had in the fourth quarter of last year. I think it doesn't take any sort of a genius to say that that would be viewed as quite negative for global markets, again, because they've reflated and they're vulnerable to some profit taking. India, I think, it does tend to key off of what happens in the global markets. There are other markets that are more sensitive to global conditions than India, but I don't think India would be totally protected from that. So again, with the market here having recovered, if there was a big crack in the US, I think pretty much everyone would pull their horns in, and there certainly would be an argument that India would correct as well.
Fantastic. We have one last question for you from the audience. It'll just come up in a second. What are your views on trade tensions between US and China and sanction policies against countries like Iran and other geopolitical developments affecting India?
So in terms of the trade policy between the US and China, I didn't want to go into all this detail when I was giving my presentation, but since we've asked the question, I'll just unpack that a little bit more. We think that there are basically two big buckets that the US and China are negotiating on. One is China buying more stuff from the United States, either goods or services. And the second is intellectual property rights and technology transfer and technology theft, to sort of put it bluntly. On the first bucket, we think that's pretty easy deal to get done. The details, of course, can be ironed out. Is it more soybeans, more pork, more airplanes, more semiconductor chips, et cetera? But that's pretty easy to get done, and we think that's probably already ironed out. The second one, which is clearly more contentious, is how do you stop the forced transfer of technology from the U.S. to China, the alleged theft by Chinese parties of U.S. technology, and then how do you monitor and enforce that? And of course, the reason why it's difficult is, number one, China will not want to admit to any technology theft, and number two, China will be very sensitive to monitoring policies because there obviously is loss of face involved in that. From the news flow that all of us have been reading, it seems clear that they're getting closer to a positive negotiated outcome, and that's why the news flow has been improving. So we think that there will be some sort of a constructive announcement because both sides, both parties, not just the Trump administration, but also Xi Jinping and the Chinese administration, we think are motivated to have some sort of a deal. That being said, the final point I'll make on this is that we don't think that this resets China-US relations back to the baseline that we enjoyed in the 2000s. We think that the level of tension between the US and China is kind of structurally higher now going forward than it was back a decade or more ago. And that's obviously for reasons of China's become bigger, it's more of a strategic threat to the United States, and there's a lot of areas that have been they've agreed to disagree on for the time being, which remain unresolved, including things like human rights and military incursion and other sorts of geopolitical aspects. So I think that there will continue to be a level of what you might call co-opetition between the U.S. and China. They need to cooperate because of the trade relationship, but they are strategic competitors, and we think that'll basically define the nature of the relationship between U.S. and China going forward. Just quickly in terms of the other aspects, I mean, the sanction policies against Iran, I mean, obviously the clear linkage to India is through oil prices. Oil prices spiked up in the last day or two following the announcement of harsher sanctions. The reason why we're not expecting things to blow off too much to the upside is we think there still is plenty of excess capacity. In fact, there was news that Saudi, could ramp up production. There's also the structural shift away from as much energy-intensive production, for example, in the automobile industry. And then, of course, there's the structural improvement coming from shale energy in the United States, which sort of puts a dampener on the ability of oil to extend too much farther. So that'd be our take on that.